Hi, today in Chapter 1 of our financial accounting text, Uses of Accounting Information in Financial Statements, we're going to discuss Objective 3. In Objective 3, we explain the importance of business transactions, money measure, and the concept of separate entities to the accounting measurement process. Back in Objective 1, when we began the chapter, we basically looked at and asked the question, what is accounting? And we discovered that accounting is an information system that measures, processes, and communicates financial information about business entities. Well, before we can really go much further, we have to ask ourselves the question, how do we go about this? And we start with accounting measurement. And we have to ask ourselves 4 basic questions. First, we ask ourselves, what is measured? We have to look at what's taking place within the business. We have to recognize that some business activity has occurred that is an economic event that will affect the business. It will affect the financial position of the business. It will affect possibly profitability of the business. And so we need to determine if whatever event has taken place is an economic event that should be measured. Then we have to determine when should the actual business measurement take place. When should what is the date that will be the record, the date of record for that particular transaction. We also have to look at what the value is. What value should be placed on what is measured? You need to determine what the value is in terms of some sort of money measurement. Then lastly, we need to ask, how should what is measured be classified? What parts of the business are affected? This is where we analyze the transaction into its debit and credit parts, and then actually go about and create our journal entry. Thus far, when we look back to to the first semester, we spent a great deal of time analyzing our transactions. We're going to do that more so, and that's what accountants do on a daily basis. They look at accounting transactions and determine all the answers to these 4 basic questions. What is measured, when the measurement should be made, what value to place on it, and how should what is measured be classified. Financial accounting uses money measures to gauge the impact of business transactions on separate business entities. What do I mean by money measures? Well, we generally speak in terms of some sort of financial measurement in terms of whatever currencies we need to work in. Businesses do actually barter and do things of that sort where they exchange services for other services or goods for services. However, when we look at accounting from a measurement standpoint, we have to use a money measure and exchange. Even if there is a barter arrangement, we have to translate that, if you will, into some sort of financial money measure in order to report that for financial accounting purposes. So, what is measured? Business transactions are basically business transactions are an object of measurement. Business transactions are an economic event or some event that affects the financial position of a business entity. Transactions are basically the raw material of accounting reports, and they report the exchanges in values of things that take place within the business, maybe such as sales or payments or purchase of supplies or repayments of loans. All of those things are different types of transactions that are measured and then reported in our accounting reports. Transactions can also be what we call non-exchange events. Things like a loss that would take place as a result of maybe a flood or theft or wear and tear. Wear and tear would be what we call depreciation. Also, another non-exchange type of transaction would be paying interest on a loan or earning interest on an account. Transactions must relate directly to the business entity in order to be reported by that business entity. Money measure. Money is basically the only common factor to all types of business transactions. But you have to determine what dollar value that transaction is going to occur, or, what dollar value that transaction is going to be reported at. In other words, if we were to do a barter, and let's say I owned a pizzeria and my neighbor owns a lawn mowing service, if I wanted to barter with him, how many pizzas would equal him mowing my lawn each week? So you have to place some sort of money value on those types of transactions. We can't report one pizza equals one lawn mowing job. So you have to convert that into some sort of dollar value. And then we have, lastly, the concepts of a separate entity. Each business is a separate entity distinct from those that it borrows from, its creditors, and its customers, and also, if we're dealing with corporations, as we are, the separate entity is also distinct and separate from its owners. So now, answer these questions relating to business transactions, separate entity, or money measure. Look at items 1 through 5, and then tell whether each of the following words or phrases relates most closely to either a business transaction, the separate entity concept, or the money measure concept. Please write your answer A, B, or C next to each one of the items. And that concludes our discussion of Objective 3 regarding the concepts of business transactions, money measure, and separate entity to the accounting measurement process. In Objective 3, we looked at accounting measurement in trying to explain the importance of business transactions, money measures, and the separate entity to the accounting measurement process. Below, look at financial accounting and how it uses money measures to gauge the impact of business transactions on each business entity. What I'd like for you to do is tell whether each of the following words or phrases most closely relates to either a business transaction, the separate entity concept, or the money measurement concept. Indicate A, B, or C for your corresponding choice. At the end, please click the Submit button to submit your answers.